Hello traders, welcome here to my YouTube channel. My name is Heiken Ashi-Trader, and in today's video I would like to talk about the topic, how do I invest my trading profits? Some might say, yes, before I invest my trading profits, I have to have some. And of course, that is true. You have to have a successful system first. Then, of course, you have to have enough money to invest those profits. Nevertheless, it is an issue, and when you start making money with your trading system or with your strategy, sooner or later you will be confronted with the question, what now? What do I do with the money? And that's what this video should be about today, and I would like to show you here how I do it. I'm not saying this is the system or this is how you should do it. That's not what this is about. But maybe my approach will help one or two traders maybe to get an idea of how to possibly do it. Look, I've divided the way I handle money into two blocks. You can see it here. I call this my money cycle. There is an offensive part in the way I manage my money, and on the right here you see there is a defensive part. You see on the left is the offensive part. Of course, it's mainly about how to make money on the stock market. And as you might know, I do that mainly with scalping and trading. But there's also an important part that I haven't talked much about, and that is speculation. So I also speculate, and will tell you in a moment what kind of speculation it is. On the right is the defensive part of my money management. And there, of course, the first thing is how to keep the money. Because earning money or getting money through work or whatever, that's one thing. But keeping the money, that is sometimes not easy either. And by that, I don't just mean not spending it, but rather that it doesn't become less, nominally speaking, but also in purchasing power, of course. So in other words, how can I maintain the money, the capital that I have earned through my trading business? So how can I generate a cash flow with this money so that I get an income through it? This is part of my personal retirement plan. And yes, you see it, there it is, investments in dividend stocks. The best thing I have found so far as a passive income, so to speak, when capital is available, is indeed dividend shares. I know very well that many people have invested their money in real estate, and there's nothing wrong with that. That can be a very, very good investment, also to build wealth, no question. I just found for myself that it's not my way. Personally, I prefer that my money is invested in stocks and in liquid assets that I can sell with a few clicks of the mouse, so to speak. You can't do that as easily with real estate. That is one of the reasons. But there is also another reason. For example, I personally have an Airbnb that I own, and I can tell you just from the experience with that Airbnb and with the guests that I've had so far, and I've had good guests, but I've had others as well, that was actually enough for me and made me refrain from investing in real estate or having more Airbnbs or even permanent tenants. It was just too much stress for me, honestly. I'm not saying you can't have stress with stocks. Of course, when they go down, it can be stressful. But we'll see in a moment with my strategy on the stock market that it doesn't have to be that way. Maybe one more point regarding this money cycle here. Yes, you see it here, investing in dividend stocks. That is something that quite a few people do, and I would recommend it as well. And what I often see, a lot of people start on the right side of the money cycle. So they start investing in dividend stocks, and then they hope that this portfolio that they build up will grow over time so that they can, in 15, 20, 30 years' time, draw a nice income from this portfolio, or maybe an additional income as a retirement plan. There's nothing wrong with that, but it's just a very slow method. So I see a lot of people, and it's also often recommended by other people here on YouTube. But I see that people then do, for example, what is called frugal living. So they try to turn over every penny to invest as much money as possible in their dividend stocks. I know there's a whole movement about this frugal living so that you can live as fast as possible than just from the cash flow of the dividends. I wouldn't do it that way. So most of those people just start on the right side of the money cycle. They start saving $100 every month, for example, or $50 or $200, depending on how much is available for saving, and then slowly, very slowly, try to build up a dividend portfolio. Well, that's not my way. My way is to start here on the left side of the money cycle with the offensive part. How can I make money in a direct offensive way? And I mean really money, really cash. I do it with scalping and trading and speculating, and then what's left over, what I do not need for my living expenses, that I immediately invest in my dividend stocks. And I can tell you, that way the portfolio gets bigger much faster than if you try to save $100 every month from your salary, so to speak. Nothing against it. If you can do it, just do it. It's a very slow way to grow your wealth. Whereas in my eyes, if you go first to the left side of the money cycle, this is a much faster way to get to that financial independence, which is ultimately what we all want. And I'm going to show you that right now. Most of you will know me here because of my Scalping is Fun book. I've developed a scalping strategy that I do mainly on the DAX, the Dow Jones, and the Euro dollar. And that is actually how I make most of my money, and it's just fun. And if you're interested in this method, you can just take a look at the course. You just need to click here under in this video. There you will find a free workshop about this scalping strategy. But there's also a second source of income, and that is what I call strong trends, or investing in strong trends. So if I see a trend somewhere on the stock market that I suspect could continue, in other words, a trend where there are strong fundamental reasons why it exists, then I may bet on that trend and I may start building positions in that trend. It can be a stock, but it can also be an index, or it could be a commodity, and it can also be a currency pair. And my experience, how I do that, I put in this book here. The book is called How Do You Turn $5,000 into $1 Million? The idea is actually to make a significant sum from a relatively small capital base. And it's possible. I have succeeded several times in the course of my trading life to actually make larger sums of money with trends from an initial investment of a few $1,000s. And how to do that, and for that I just use a scaling in, scaling out technique. In other words, as I start buying, and if my assessment is confirmed by the market, I buy more than I would go long, of course. If I go short, it's the other way around. If the market continues to fall, I sell more contracts And so it can happen that in a given market, I might be invested with 10, 15, sometimes 20 futures contracts. This is a risky method, and it's not for everyone. But if done correctly, and there are also stop rules and so on, I explain all that in the book. That can really lead to larger sums, say $40,000, $50,000, up to $100,000 profit with just one trade. That is really possible. You don't get opportunities like that very often. It happens every now and then. There are maybe some very, very good opportunities every year in certain markets. For example, during the financial crisis, I was fully long in the silver market, and I think I made something like $45,000 profit with this trade. Another such a trade was, for example, in the crypto market. I was also long in several cryptocurrencies. I started to buy at the end of 2020 and until the first quarter of 2021, and I made about 400% in total on that capital. And that was really very good profit as well. I made a little over 60,000 euros profit with this trade. So it's quite possible to make money in this way as well. This is pure speculation by betting on important trends and building up significant positions. And of course, it is clear that if you can put this money aside and reallocate it to your dividend portfolio, then this portfolio can grow much faster than if you just save $100 from your salary every month. And how do I do that? You see it. I even wrote another book about it. I wrote it during the first lockdown of 2020. This was a moment in our life where we all had a lot of time. So I said to myself, why not write a book about dividend stocks? So the book is called Stocks Are Fun, Become Financial Free with Dividends, or Achieving Financial Freedom with Dividends. That's a sort of a standard book on dividend investing. And it's a book that a lot of people don't have on their radar yet. And I would like to recommend it with this as well. I think it's a good book also for those who are interested in dividend stocks. First and foremost, how can you grow a dividend portfolio faster if you invest in dividend stocks? In other words, yes, the conventional dividend stocks that most people own, like, for example, McDonald's, Procter & Gamble, or IBM, they'll give you maybe 2, 3, 3.5, 4%, or at best 5% dividend yield a year. That's not bad, but obviously you're not going to be able to grow your portfolio quickly with that kind of yield. In other words, we need much higher yields to really get to our financial freedom faster. And by higher yields, I mean dividend yields starting at 7%, 8% upwards, and they do exist. You can buy dividend stocks, and there are also dividends, in particular in the so-called REITs, which are real estate investment trusts. And the advantage of those trusts is that 90% of the income has to be distributed to the investors. So, in other words, much higher dividends are possible here for the investor. There are different types of REITs. So there are the classical residential REITs. The fund simply invests in residential properties. Then you have mortgage REITs. There are retail REITs, and they are in all kinds of different sectors. Quite interesting stocks in my eyes. Then you also have dividend ETFs. I do not want to go too deep into that right now, because that would actually require its own video. So with this dividend ETFs, additional income is sometimes created, in which often, for example, options on securities are sold by the management. which the ETF holds. So the fund buys shares, and then, for example, they will sell covered calls on those shares, and this generates additional income. And of course, this means that the dividends of those ETFs are higher, often 9%, 9.5%, and even more than 10% annual dividend yield. The same is true for the so-called covered call ETFs. They are being around for many years in the United States as well, and that is also something to look at. Then we have so-called closed-end funds, CEFs. By the way, those funds are actually quite old. They have been around for a very, very long time. Some people think these are new inventions and they are risky investments. But actually, they're much older than the usual mutual funds. It actually works like a conventional investment fund, except that the portfolio is closed. That is why it's called a closed-end fund. And as a result, also thanks to the leverage, the dividend yield is generally higher than with the usual dividend stocks. The same applies to the so-called preferred shares. So you have the normal shares, but you can also buy preferred shares, and these also have a higher dividend. It's actually kind of a mix between a stock and a bond, you could say. It has the advantages of both combined into one. It's a hybrid security, quite interesting. So there is a higher yield as well. Often they are distributed quarterly, but there are also monthly payers with these preferred shares. Last but not least, I might buy so-called MLPs, which are Master Limited Partnerships. Those funds often invest in oil and gas companies. In other words, these are very long-term commitments. Here, the risks are manageable, but the big advantage of those MLPs is the continuous cash flow that these MLPs distribute. So from that point of view, very interesting for an income investor like me. This list, of course, is not complete, but I think this small list contains the main types of stocks or funds that I invest in and from which I generate cash flow or an income. Since I do not rely on that income right now, I obviously have the ability to continue to grow that portfolio by just reinvesting the dividends. And that is, of course, the turbo for a portfolio. If everything that comes in, so what I invest through my trading business anyway, and additionally through the dividends that come in when I reinvest them again, you can imagine that such a portfolio grows much, much faster than a conventional stock portfolio. So I try to invest in high dividend stocks where the cash flow is not only coming regularly, but also as high as possible. That is one point. Then there is another point I want to make here, how I invest. You see it, it's what we call dollar cost averaging. I have no problem at all to buy a stock again, which I already hold, if the stock is down 30-40%. If I am convinced of this stock or of this company, and if the price of the stock goes down 30-40%, then I might buy again. This is called dollar cost averaging. You see it illustrated here. Let's say, for example, you would buy $300 worth of stock every month. If the stock trades at $30, obviously you can only buy 10 shares. If the stock goes down to $10, which of course would be extreme, but possible, then you can buy 30 shares. If it goes down to $20, then you can buy 15 shares and so on. So the idea is actually that you do not buy the position all at once. So for example, if you want to invest $5,000, you do not buy everything at once, but simply give yourself the time to buy when the stock or the fund simply becomes cheaper. And those opportunities always come along, as we know. There are always times when the stock market comes down 10, 15, 20% or even more. That is the time when individual stocks or funds simply become cheaper. And then maybe the moment has come to increase your position and just buy more. And this way, you do not have to be afraid of losses. Well, the only risk is, of course, a total loss on the stock. So if the company would go bankrupt, that can happen. And that is also the reason why you should diversify a stock portfolio. So you should not put everything into one share, but hold 20, 30, even to 40 or 50 positions at the same time, especially if the capital becomes larger. That way, you might invest a maximum of 1, 2, or maybe 3% in one stock. In other words, if a total bankruptcy were to occur, then you might have a 2% loss. But that, in my view, is something you can get over. So from that point of view, I'm quite conservative and I'm completely independent of my timing, which I am not with my trading business, of course. Timing there is totally important. Here, in long-term income investing, timing is not that important. I don't care if I buy a stock today at 30 and in 2 months it's, let's say, at $20. I just buy more of that stock. No problem. So that is the idea, that you try to get the entry price cheaper, so to speak. The cheaper the stock is or the fund, the more shares or units I can buy. So the higher my dividends will be after that. So basically, it's even good for a dividend investor when the stock market comes down. It's more an advantage. We had in recent years the problem to find still affordable shares. But fortunately, this seems to change now in recent weeks as for March 22. If the stock market should correct 20, 30%, and one day this moment will come, then that could look completely differently. Because at that moment, you can buy actually very good dividend stocks with clear discounts of 30, 40, and even 50%. That is why it makes sense to hold sometimes a portion of your capital in cash. That is what I do. I have a part, and even at this moment quite a large part, in cash, and I'm just waiting. That is also part of long-term investing. You do not necessarily have to be 100% invested all the time. So dollar cost averaging is part of the dividend strategy. But there is another important part of my strategy, and that is called monthly dividends. It's much more fun if I get money every month. I personally prefer that method. I actually usually almost always look for a monthly payer. They exist in stocks, they exist in funds, and they exist in MLPs and in REITs. So there are enough funds and stocks that pay dividends every month. And there's a lot of fun in that. When you realize every month, aha, money has come in again from all kinds of sides. But now there is another important reason. Not only this emotional reason, because that is, one could say, does it really make a difference whether you get your $2 in dividends quarterly or whether you get it neatly divided into 16 cents per month? The answer is that it does make a difference, and there are studies on this. So they found out that after 6 years, the difference between a monthly payer versus a quarterly payer, the monthly payer is already 50% ahead. You can see it in this graph here on the right side. But after 10 years, the difference is already 100% more payout. And you can see after 20 years, that is when the curve starts to rise exponentially. And that is the reason why I say that I'm mainly looking at monthly payers. If there is not a good monthly payer and there is a quarterly payer, it's also okay for me. So every 3 months I get the dividend then. But if I can, I always prefer the monthly payer because of this mathematical fact that you see here on the right side. And there is maybe a third reason why I do this way and why I do not go for dividend growth, for example, which a lot of people do. Dividend growth is a strategy that's also good, but I would recommend it more to younger people. If someone has an investment horizon of 25, 30, or even 35 years, so very young people, if someone has such a working time ahead of them before they retire, then it might be interesting to rather choose this dividend growth strategy. So that means that you rather pay attention to the fact that the company increases the dividend annually or semi-annually or whatever, because it can happen to you that a certain stock, which you perhaps bought at some point where the dividend was, let's say, 2.5%, that after a larger number of years, that you have in relation to the original capital, you can have a dividend yield of 10, even 15%. And that's interesting, of course, no question. If you have that time horizon, it's really a good idea to do it that way. But for me, and I'm over 50 now, I actually want to be able to live off this portfolio pretty soon. I don't have to, because I have enough income from my trading business. I'm not dependent on it. But as an additional retirement income, so to speak, it's interesting for me, of course. And that's why I'm betting on high dividend stocks. So I am betting on direct cash flow. I want to have the money now and not in 25 years. So you have to make that distinction. There's a difference if you're 25 or if you're 55. And then there is another component to my dividend strategy. Yes, take profits now and then. You have to sell a stock every once in a while that has done well. So for me, stocks are not for eternity, as they call them sometimes. There can be several reasons why you can or maybe should sell even a dividend stock, even a good dividend stock, by the way. One reason could be, for example, if the stock has a multiple of the annual dividend in capital appreciation. If you have, for example, 10 years of dividend income in capital appreciation, so if the stock has 50, 60, 70% price gains, then perhaps the time has come to think about profit taking, or at least partial profit taken. Certainly if the stock has a 100% gain or more, then you might simply take the money off the table, or at least put a stop loss so that you can realize the gains. Another reason could be that the stock, for example, because of the profits and because of the reinvested dividends, takes a too large a share in your portfolio. This is, of course, a certain risk as well. And also here, as with my speculation strategy, I just choose not only the scaling in, so the dollar cost averaging strategy, but also the scaling out strategy. That means, for example, I could just take 50% of the money out and let the rest run. And this 50% I can reinvest in other stocks. For example, if a certain stock has come down 20%, then I can buy another position there. So that's my dividend income strategy in a nutshell. That's the defensive part of my money cycle. So actively, I'm trying to make money through trading in the short term, if possible. I have a trading business, and with that money, I kind of feed my retirement, my stock portfolio, which is more defensive in nature through dividend stocks. But I also actively manage those dividends. While I'm not day trading them, some stocks are in my portfolio for years, but I've given few reasons here why sometimes you should think about taking profits and why sometimes you should just sell a stock. So I hope you got something out of this video, and I would be interested in what you think about it. And if you feel like, you can of course share your comments here below this video. I'm looking forward to the discussion. Take care, and I wish you very much success in the stock market.